All right. Good morning, everybody. So we got our 3% move yesterday, and we spent a good part of yesterday also unwinding that move, kind of closing the gap. Today it's FOMC, which I'm sure by now everybody knows. It can't be a surprise at this point. One thing I continue to try to stress with people is we are still in the same location we were near the end of October. We really haven't done anything in weeks. It may feel like we're getting something accomplished, but we haven't gone anywhere. Newer traders continue to hit me up every day. Hey, you got a trade? You got something I can, go put some money on? And it's that lack of patience, lack of awareness for the conditions going on around us that tend to get you into trouble, lose money. We have to get out of this range and get moving in one particular direction or another. And today should be the day to finally galvanize this market. Like I said yesterday, we never want to say that price can't do something. So in theory, at the end of the day today, we could be right where we were, and at the end of the week, we could still be in the box. I don't think that that's very likely, but price can do whatever the hell it wants, including still being in the box at the end of the week. It's a pretty quiet news morning, mostly connected to that fool that got himself arrested down in the Bahamas. And other than that, everything is focused on FOMC today. There is some under the radar stuff that on any other day we would be paying attention to, like the crude inventories today and import prices. But today it's all about the FOMC. As you can see, we got a lot of econ just all piled in there together. We do have some inflation expectations that come out today, but really at the bottom of the barrel, everything that matters is at 2 o'clock when the announcement comes out, and then at 2:30 when Powell actually comes out talking. Until then, it's very likely going to be a day where we maintain a sideways range. The ceiling is more than capped from yesterday, so 41.40, even 41.50 area. That is pretty much where we had our 3% line drawn yesterday. I found it interesting. We went to that 3% line in like 30 seconds. Overshot it too, by the way, a considerable amount before coming back in and holding around that 3%. It ain't bragging when you're right. Volume is really light, but this is not a surprise. So there's nothing that we really need out of this. Get it out of the way. And as you can see, we've got a very narrow IB. It's IB is initial balance. If you think about a 1 hour open range or a 30-minute open range or a 15-minute, you choose your time frame and it happens at 9:30. The initial balance is 1 hour. You don't get to choose anything else. It has to be 1 hour, and it starts at Globex open. So it goes for 1 hour from that open. Within that IB, within that 1 hour open, it's where we typically classify what kind of open we had. Did we have a wide IB, a narrow IB? And then the implications that come from that. If it was narrow, it kind of implies nobody really did anything yet. And if anybody has trades that need to be done, they haven't been done yet. So there's unfinished business, unfinished work, and we're very likely going to see a move later in the day. As opposed to if you get a really big IB, then it kind of implies there were people already in there trading. They very likely got at least some of their work done for the day, and they may not need to come in and trade later on. Not a surprise with a narrow IB. We expect the big move to come later today. Of course we do. It's where the FOMC is today. We are in an MDP. We went from an MDP yesterday where we stayed above to being in an MDP where we are underneath. That's a missed daily pivot. It's not really a surprise because we're just not going anywhere. The previous week's high is at 40.75, and we went through that yesterday and then found support on it through part of the afternoon before dumping down through it again. It's amazing how those pivot points work. We're going to game it out today, just like we did yesterday. The FOMC today is very likely going to cause a significant move in the market. Dun, 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 dun. Thanks, Captain Obvious. A 3% move would get us just outside of yesterday's range. I think we got more in us than that. But let's just start with that. So that's 3%. Since today is supposed to be the entire year all wrapped up into the next 2 weeks, it's very likely that we're going to see more than this. So let's measure a little bit of an extreme. If that's normal, what would exaggerated look like? Let's give a 5% move. 42.67. It'll be the Odang level, 42.67. All right, so from our current location, do the same thing in the other direction. 3% move. $39.33. That's really close to this low back here at 39.29. I think we're going to use that. It's really close. Price will gravitate to something like that if it gets close. And we got to have a 5% move to the downside. 38.5. Imagine that. Right back to 38.5, a pivot point that's become an old friend by now. With friends like that, who needs enemies? And we've got our range for the day. Now keep in mind, these are oh dang levels. As in it moved 5%. Ah, dang, that's a big move. These are really big moves. If you look back on the year, we've made a 5% move this year. It's not unusual. Look at 2020 during the COVID situation. We made multiple 5% moves that year. So we can move 5%. It's not something that's, never been done before. It's not normal. It's not common. Typically, when we see a 5% move in the market, we've already spent part of the day earning that move. And this is really important to understand. Half your trading day is already done. It started last night at Globex Open. By the time the US markets open, we're winding down the day from a global trading day. Typically, when we've made 5% moves, it started during the Globex, continued through our trading day, and ended up becoming a 5% move through an entire day. What we're talking about here is staying range bound all morning long, going into the afternoon, and then seeing a 5% move in an hour and a half. So when we talk about, a rate of change and the feeling that things were just very violent or drastic, that would be very violent or drastic, moving 5% in an hour and a half. We moved yesterday 3% in 30 seconds. Does it feel violent yet? We were just talking about it, but visuals help. This is the range that we've been talking about for weeks and weeks. If you wanted to adjust it just a little bit and use last week's very big red candle, it kind of makes it a little bit cleaner, but we don't need to do that. Either way, we are right where we were a month ago. So the idea is we need out of this box and we need to keep it. In technical analysis, this fake out here is preceded by a significant drop through the other side of the box, starting with at least the measurement of the box at 50% and 100%. So we would do something like measure the range, plot that range out 100%, 50%, right? That would be normal technical analysis. Now, the problem is this week isn't closed yet. So looking at this, this week's candle and saying, well, we have the short signal. We actually don't have the short signal yet because this candle isn't closed yet. If this was Friday afternoon and the market was closed and we've seen this pattern, this is what we would do about it. But this candle's closed. So by the end of the week, this week, we're going to very likely have our decision about where we're going to go for the rest of the year. Hopefully you've had the opportunity to plan ahead and really kind of consider what you're going to do with that. We'll either be, jumping on Apple and crushing it into the dirt over the next 2 weeks, or just hopping on it and riding it up into the skyline. Tesla's not waiting. It's already making an exaggerated move again to the downside. It got a Goldman Sachs downgrade overnight. And something that you want to pay attention to when it comes to analyst upgrades and analyst downgrades is, one, why did they downgrade it or upgrade it? Any kind of analyst recommendation, any analyst rate change. They're supposed to come out with notes explaining their new position or their new point of view. And then watch the chart. If they give it a downgrade and it rallies anyways, oh, that's a really strong move. Usually makes really great day trades when a market bucks the analysts and goes against the system. It's already made some significant moves to the downside, but I mean, so has a lot of other stuff. So that by itself doesn't give us too much. Just keep in mind, it rallied yesterday when we got CPI, just like everything else rallied. So it might be down this morning, but one, it's not down by much. It's like down $1. Percentage wise, it's not down by very much. And two, if everything was to suddenly turn positive, this also is going to turn positive, right? Just like what happened yesterday when the CPI came out. So don't make this mistake of thinking, well, yeah, I don't need to worry about FOMC today. This thing's already bearish. It will turn bullish if everything else turns bullish. It's a rising tide lifts all boats. All right. When we're at the bottom of the box, we expect to go to the top. When we're at the top of the box, we expect to go to the bottom. We moved through the shallow area relatively quickly yesterday. $40.80 is where the current level of resistance is at. When FOMC comes out today, it won't matter what is on this chart. It won't matter where the volume is or anything else. Until then, though, talking about being range bound, we could move up into the 40.80 area, just through market mechanics through the morning. Wouldn't really expect to get much beyond 40.80 until after FOMC. And the same thing with 40.20. And I think that really defines our range today. 40.80 to 40.20, it's a good 60 points. And I really don't expect to do much beyond that until POW, right? And that's fine. That's 60 points range is more than enough. We don't have a VPOC to carry over from yesterday because we've crossed through it multiple times already, but the volume profile significantly highlights the very narrow range that we're in this morning. Much better than me drawing boxes on it. None of these lines or values or pivots will matter once Powell opens his mouth, but on any other day, we would be focused on those. 40.80 to 40.20 should put us a little higher than our own Globex, which makes sense if we're going to, deal with the way the strat Rob talks about price aggregates. I hate that word, but that would be the idea that every time we come back to the box, we get to the edge of the box, that it just goes a little bit farther. And then the next time it goes a little bit farther and a little bit farther, and a little bit farther, until finally it just goes one direction or another, often forming a megaphone pattern. With that in mind, going through the top of our current Globex high, a little bit higher into 40.80 makes perfect sense. And retesting the Globex low of yesterday on the downward move. Yep. I would set it into zones, 40.80, 4100 on the upside, and 40.40, 40.20 to the downside. And that would give you more of an 80-point range to play with before Powell today. And also it gives you ranges for a morning iron condor if you want to. I'm not a big fan of those. I won't be putting one on, but hey, to each their own. It would be worth asking the question, did we move too far too fast? But considering we gave the move back, we're still sitting less than 2.5% away from the 10-week moving average. And while that is a little high, it's not at a reversal extreme. Yeah, I mean, that's just about the spot where we would expect it to start to pause, consolidate, maybe begin moving back towards the 10. But it's not extreme yet. So we are overbought, but not exaggerated. And on the daily, we're only 1% away from a 10-day moving average. So that's fine. We're not overbought at all on a day-to-day basis, well within our boundaries. We're not in the middle of the court anymore, but we're not that far away. The anchored VWAP has caught up with us. It's this heavy cyan line running across the chart. We actually went through it yesterday and came back down. You know, if it was earlier in the year and we were flirting with that anchored VWAP, it would have a lot more value to us than it does now. The end of the year is 2 weeks away. It doesn't matter at this point. But it will matter, you know, at the start of next year, where it starts and what we do with it immediately, whether we get above it or below it. A lot of fund managers just want this year off the books. And that kind of provides the real threat to the downside. Remember what we continue to say when it comes to Apple and Microsoft. Those are the darlings of Wall Street. If they start selling those because they just finally said screw it, if they're not willing to buy or hold Apple or Microsoft, why in the heck would we expect that they will buy and hold anything else? Continue to look for any articles that talk about redemptions. We haven't really had some shock and awe, fear and greed kind of thing for a while since we've been so range bound. But if things are to begin getting nasty and we start revisiting 37 and 3600 before Christmas, redemptions are going to be something to be watching for. Natural gas down nearly 5.5%. This thing's a mover. Like ADD, schizophrenic. It doesn't know what it wants from a day-to-day basis. So it's a solid green candle. That implies that we gapped up and then we spent the day falling back down. And now we have gapped up again today. This is an alternative product. It's not going to run in a correlated market state with a beta, a positive beta. It's got a negative beta. So the expectation is this won't necessarily do what the rest of the market does with FOMC, with news, with what, whatever. That doesn't mean that it won't at all respond to the market. You can see yesterday when we got that econ with the CPI, it did move higher along with everything else that moved higher, but it didn't move higher as extreme as everything else did, right? Because again, it has a negative beta. So through the day today, you could see opportunities to trade this, since it very likely won't be something that needs to wait on Powell. We get the petroleum report today at 10:30. So USO is something else that you could look to trade during today while you're waiting on Powell, because this won't wait or won't need to wait for Powell. There's always something out there to trade, right? Portfolio diversification is more than just, well, I've got some longs and I've got some shorts. You want to diversify your portfolio with your betas as well. Two green candles in a row. Again, showing that we gapped up and then we gave it all back, gapped up again, gave it all back. We're getting higher close. Higher lows. We have a gap to close at 1362. We have another one at 111.88. And 110.22. One thing of concern, these are really bullish gaps. And it just can't keep it. It just keeps falling right back down again. That should be a little bit concerning. And it might be because we're starting this rotation. Everybody's kind of pre-Powell prepping. That's a lot of P's. It could be because of that. But it should still make you nervous to see this kind of aggressive gap up that can't stick, and it just keeps falling back down. The thing is, the range is holding, so it's not like it's time to short bonds or something. I wouldn't say that. Here's the ZB, the 30-year. The range is pretty clear. We need to get out of the box. On the week, this looks really beautiful. And it only looks like we're pausing momentarily before continuing that move up. 135 would get us into the bottom of this price structure back here. If we get above that, we could be looking at 142 into, say, 145. It's going to take a while. This thing has already made some pretty good sized moves. Just keep in mind, we're looking for a systemic shift in market structure after today. It's not going to just be what price does today. It's going to be, what did Powell give us that's going to lead us into February? You got to think bigger picture on this one. So if we're still looking for that capital rotation with a focus on the 60/40 bond stock portfolio, which has gone straight into the toilet in the last few years, it's coming back. Then it's very likely we're going to see a continuation of this bond recovery. But we have broke decades of support. Any way that you want to draw it, we've broke it. It's going to take a long time to recover from something like this. Starting, with the COVID mess and the continuation on down through. We're looking at 07, 08 housing levels. So in the bigger picture, I guess the main takeaway is we're very likely not done going down in bonds. So if you're thinking about loading up the portfolio with an alternative beta product, you start buying long in bond, be prepared to hold on to some pain for a while. We still got yields coming down off of that $44 level. I'm actually looking for something that I keep saying I'm going to do. At Stock Charts, this was the first subscription I ever got when I was new to trading. They have this little system here. And what it allows you to do is put in different things and it will show you the relative strength of it. And they have one for yields. And what's really cool is when you hit the button, it actually goes live and it starts turning and rotating and showing you how these things interact with each other against a central benchmark. So what we've got here is the 3-month, 6-month, 1 year, 2 year, 5, 10, 20, 30, and it's the yield curve, right? And right now we've got the IRX, which is like the 1 month front end, really front end. It's not the one I want to see. No, I have to work it out. The idea is this thing is going to visually demonstrate to you that as the front end continues to rise, it drags the rest of the back end up, whether it wants to or not. I'll put together a better visual on this, but I end up having to make a video on it. The thing is, though, what I was getting to, yeah, that. The front end of the curve is extreme right now. We're not at 07, 06, 05 levels, but I mean, we're pretty high up there. You talk about finding something to trade. We don't trade this, but if if you found a stock that looked like that, you would buy it, right? You'd be all over that thing. It's not done yet. The current candle that we're looking at is a monthly candle. It's December's, obviously. And it's red at the moment, but December's not done yet, Captain Obvious. We could still yet see a green candle showing yet again a continuation, even more. One thing of note, things are slowing down a little bit. If you look at the wick depth from the last candle, where we actually gapped up, faded back only enough to close the gap and then rallied higher, this time we opened and we dropped and we hit more than 50% of the last month. Now it bounced up, it held above the 50% line, but it touched it. And it's the first time we've even seen that kind of weakness in a long time. All of this year, right? From the start of the year all the way up, we did not intersect with 50% of the candle once. Talk about an example of what a really good trend looks like, right? And that's, I would even argue that's not even a trend. That's just parabolic madness. A trend at some point should have pullback somewhere along the way. This had none. Never hit the middle of one of these candles once it took off. Till now. So we are finally starting to see a little bit of a change in market dynamic. Not much. It's very likely still not done, but it's a start. As this begins to stabilize and kind of calm down a little bit, we're very likely going to see the others begin to play catch up. Well, this is the very front end, like 1 month. So think about what's going to happen to the 10-year once the 1 month finally starts to calm down a little bit. That 10-year still has a lot longer to go. Without the visual, I know this might not make a lot of sense yet, but I mean, that's just, it's the way that everything works, right? Think of it again as that rising tide, only this time it's just on the yields. The curve is supposed to be like this, with the 2 month way down here, and say the 30-year way up here, something like that. So when the front end goes up, we get an inverted yield curve. That needs to change. Once it finally starts to slow down a little bit, the back end can start working its way up. First, just to get to parity, and then finally to get above. So if you're looking for something for, say next year, there's probably still some room left in the 10-year. But it's not going to be, you missed the easy money already. Let's say it that way. Even if things go really good today and we explode higher, it's not supposed to stick, right? I don't know any analyst out there who says that next year we're going to be done with these lows. I have seen a couple of firms, Goldman Sachs, JP Morgan, say that by April or May of next year, they expect interest rates to be, or not interest rates, inflation to be down around 3%. I call bull. I say I don't believe that. That's some pretty rosy expectations. If we are sitting at 3% by March or April of next year, that would be awesome for the market, but I don't believe it. could very likely get at least one more hurrah to the downside, even if we get this positive rally up. So we're looking at Apple at like 170, call it 175, if the market rallies into Christmas. But still, before the February FOMC, I still expect this market to roll over at least once. And if it's negative today and we just start going down, then we're going to focus on Apple at 115, maybe 119. $120. Same thing with Microsoft. Things continue today from a positive perspective. We could see Microsoft, pushing that 285 area by the end of the year. If they're negative today and we're going to run negative into the end of the year, then we're looking at Microsoft getting below that $200 mark. Seen some airline talk this morning. A little bit of a warning on that. The airlines are notoriously bad at managing money. They have really bad credit ratings. So when they borrow money, they have to do it at a higher cost. They're poorly managed institutions with a lot of government interference. Delta came out this morning with some really rosy numbers on the expectation that travel conditions are improving and people are going to travel more. It all looks really good on paper, but these guys just not, and I'm not picking on Delta, it's the entire industry. Approach with caution. If you're looking for something, long-term buy and hold, they painted a pretty picture. It is beat down a lot, but from a company perspective, they're just poorly run, the entire industry. It's something to think about. If you do want to try to focus on the airlines and the cruise lines, it's the kind of, two peas in a pod. Look at the fundamentals. I'm not one to sit here and stress on the fundamentals on a day-to-day basis. It's not my thing. But if you're going to trade into these for a longer term buy and hold and you're putting them in your portfolio, know what you're getting. Right? If it's just a trade, who cares? Don't even bother. If you're just getting in, getting out, running it a week, a month, the fundamentals are going to be sitting in backseat to whatever the candles are doing. Fine, no problem. But long term, going to grab a hold of this thing and maybe give it to the grandkids in a few years. Be particular. They did have a good earnings, though. It's worth a read, or at least just listening to an interview. I think they gave a couple this morning. I'm looking at this as a reasonably decent short if I can catch it at around 36, 35. Like, maybe a call credit spread or straight up buying some puts. It depends on how it goes today. But I think the exuberance is going to wear off. I wouldn't short it yet until you get a short signal, though. Don't short it just because it moved far. We need more than that. All right, PDD inside week. This is going to get whacked like everything else has been getting whacked, but these are some of the names that took a significant beat down and is now trying to come out of that base to the upside. If this thing can hold above $70 through this PAL mess, then you know, a long in here might not be a bad idea. This all goes down towards the China reopening. This isn't the only name by any means. JD, PD, you know, of course, Baba, Baidu, Billy, Neo, all those ADR names. Obviously, I mean, JD doesn't look half as good as PDD from a chart perspective. It looks like trash. Baba got that TRB. It's going to be a long slog here. And China's getting overrun by COVID cases. So something to keep in mind. Those ADRs are very likely going to get whacked over the next few weeks, especially if they start tightening the screws after just beginning to ease up on their COVID restriction policy, right? That COVID zero system. If they start tightening that thing back up again, these ADRs are going to get punched. So at least it's something to consider, you know, other than just the same old stuff, Apple, Netflix, Microsoft, Amazon. It all comes to PAL. We run it to the end of the year. So everybody be careful, be safe, have a good day. I will see you all tomorrow.